Hello, welcome to LCG's preview for the week ahead. It's our first week ahead for 2019. I'm going to discuss the US government shutdown, the Japanese yen flash crash, and FOMC minutes. Before that, I'll run down the biggest events in the economic calendar. On Monday, there is China foreign reserves, German factory orders, and US ISM non-manufacturing PMI. On Tuesday, there is Swiss retail sales. On Wednesday, we have the Bank of Canada rate decision and FOMC minutes. On Thursday, there is China's CPI for December and Swiss unemployment. Then on Friday, it's UK GDP for November, German ZEW, and US CPI for December. Moving on to the top corporate results to watch this week, where outside of retailer holiday sales, it's typically a slow start to the new year. For those trading UK equities, on Tuesday, Morrisons releases a Christmas trading statement. On Wednesday, Sainsbury's and Greggs release quarterly sales and Shoezone its full year results. On Thursday, John Lewis, Tesco and M&S release updates, and on Friday, Game Digital estimates its Christmas sales, and AO World gives its full quarter sales update. So a quick note that the LCG quarterly outlook is out now. That's on the market reports section of the LCG website, so you can see our take on the major currencies, commodities and indices there. But specifically looking ahead to next week, obviously question marks as to whether this US government shutdown lingers on. Trump wants funding for the wall and he can't be seen to back down. Democrats don't want to sign off on a policy that they want to be seen as morally against. So the risk here, and I think this is what's being priced into markets, is that it becomes more protracted and then obviously the longer this thing trundles on, it starts to impact economic growth. And given the fact that global growth fears are one of the dominating forces for the fears that are going through markets at the moment, you can understand why any risk to US economic growth, which has been the one sort of bellwether, shining force throughout the sort of general global weakness, is not something that the markets have wanted to see. So the shutdown, should it end next week, could actually give markets a little bit of a boost after what has been a fairly rough start, I think it's fair to say. On that front, China data next week will be important. So any decent surprises from China again could boost sentiment. Equally, some rough figures could add to the sell-off. That's what we saw from the PMI figures that were released on the first day of the new year. Wanted just to mention this yen flash crash. Technically, it wasn't actually a crash in the yen, since the yen actually went up. It was a crash in dollar yen, as well as the Aussie yen. Now, I think Aussie probably participated here because there is some speculation going on in terms of China's economic weakness. As we mentioned, we've got the soft China data, and so the Australian dollar's fallen, and there's a flight into haven assets, and the Japanese yen is one of those. It's a similar but not as severe event to the pound dollar flash crash we had 3 months after the EU referendum. It's similarly to that occasion. It's a combination of thin Asian trading hours combined with big bets over certain fundamental issues. In that case, it was Brexit. This time around, it's a bet of moving into the yen with haven flows and a drop in US economic yields, which tends to correlate well with the dollar yen. And added to that mix is just the algorithmic trading. So when stop losses get taken out, you see particularly big moves as I said, in those thin Asian trading hours. So from a personal trader perspective, it is actually an increasing risk going forward that you have to consider when trading FX markets, that you could get these sudden bolts of volatility. Again, it's something that happens in any market. You could perhaps go some way to avoiding it if you aren't trading the Asian session, but that also reduces your opportunities too. It makes it very difficult to hold trades overnight. So again, it's just one of those risks that you have to be aware of. Can occasionally happen, these big flash crashes with several percentage moves, which is above and beyond what you normally expect in the FX market. Last but not least, the FOMC minutes are out this week. So stocks did end up tanking after the Fed hiked rates in December. Government bond yields have rallied. So actually government bond yields in the US have been up for bonds have been up and yields have been down for the last couple of months now. I think the takeaway by markets to that meeting, rightly or wrongly, was that the Fed no longer has their backs. So Jerome Powell was fairly clear that he wasn't going to be watching markets as a factor for whether the Fed hikes rates. The Fed did actually, according to their dot plot, reduce the number of expected rate hikes in 2019 down to 2. So not necessarily that quarterly rate rise that we're expecting, but the difficulty there is that markets are actually pricing in no rate hikes in 2019. Lots of it coming down to that flattening and inverting of the yield curve, indicating recession. So in summary, with the Fed expecting 2 rate hikes, obviously they're expecting a little bit of economic weakness come into next year, but still even 2 rate hikes from the market's perspective could be seen as a policy error and actually bring on the recession and add to the global sense of the sense that the global economy is weakening going into this year. Thank you very much for watching. Good luck with trading this week. And if you want to see these videos as soon as they're released, please follow LCG on YouTube and social media.